We want to visit an ETF we've discussed before, JNK. This is the Bloomberg Barclays High Yield ETF, meant to mirror the Bloomberg Barclays High Yield Very Liquid Index. Yes, indeed, there is such an index. We've been comfortably bullish this ETF for the last 6 to 12 months. However, our thinking has changed, and we want to suggest it just might be time to change your thinking as well.
So let's take a closer look at JNK. As you can see, since the low at 81.30, it has been a bull market. The market has been rallying for the last 12 months, up and to the right, as they say. Going one step further, please note how it has also provided higher highs, which is what you see with the pink squares, and higher lows. So not only has it been trending higher for 12 months, the requisite higher highs and higher lows continue, again, consistent with a market that is bullish. One of the things that you may notice is that declines since last year have been three-wave moves. You can see that as shown with the red arrows. Every major decline has been three waves. Now, even in the small declines here, right here, you can see a little three-wave move. Even currently, maybe even still a three-wave move. So no impulsive moves to the downside. So no major signs from a trend-following technique that this market is anything but bullish. But here's where the concerns come in. You layer in something like a divergence of any momentum indicator, and you notice that momentum peaked around here, and the higher highs in price are seeing significantly lower momentum. Now, this divergence is a warning sign that perhaps the market is topping out, so you have a conflict between higher highs and higher lows, but some warning signs that are emerging right here that says this market is indeed not bullish anymore. This is where Elliott comes in. Now, when you look at the wave count, indeed, you can make sense of the move higher, which is not impulsive, by counting the entire thing as a correction, as we have been doing for subscribers. So you can see the A, B, C here for W, X, Y, another three-wave move for X, and yet another three-wave move to finish this off in wave Z or wave Z. So this allows for the higher highs, the lack of impulsive downside, but at the same time, it also speaks to the fact that from a wave perspective, that this entire rally is getting into the latter stages. Even here, the diagonal triangle, as you can see, to finish wave 5, suggests that the market is coming into some kind of top. So Elliott takes it one step further. Now, putting it all together, we do note that corrections continue to be three ways, which is a little bit bullish, but divergences, as you can see here, are warning, and what we've been telling subscribers is to look for a strong top. So to put it all together, we've been bullish this for a very, very long time. For most of the last 6 to 12 months, we are now looking to confirm a move to the downside. We'll look for a break of support, this wave 4 low, this wave 2 low. At least a correction back into this 102.54 area would be a start, but this is how you can use Elliott alongside trend following techniques to not only help you understand where the market's going, but perhaps, just perhaps, a warning sign of when the trend is likely approaching an end.
In a risk-on, risk-seeking environment, sub-investment grade bonds are very liquid, an important part of many portfolios, and are considered high-yield bonds. But if risk starts to turn, liquidity turns with it, and investment grade or sub-investment grade bonds often quickly become junk bonds. And because of that, this is an ETF we want to watch particularly closely.